if you could put yourself back now, you were talking about investing and how it's shifted over time. But if you were, and you were also talking about the private markets, how there's a lot more opportunity there. But if you were a kid coming out of college, and we're both alma mater, Cornell, but you graduated in 1979. But if you were graduating today and you had to actually play, if you will, the public markets, do you think that opportunity that you had in 1979 still exists in 2023?
You know, Andrew, it's such a great question. I think that markets can become more efficient. And there's a question in my mind about once a market becomes more efficient, whether it actually does have the likelihood of becoming less efficient afterwards. So for sure, there's more money in public markets, things have become somewhat more efficient. But I also see a short-term orientation that tells me that it's possible some pricing has actually become less efficient. I think when you look at Meta, the stock's been all over the place in a reasonably short period of time, falling to under 100, then rising back up to almost 300, literally months apart, for a large, well-established company that I think everybody can analyze. So I think that there are opportunities. Now, if a kid came to me and said, where do you think I should potentially make my career, I would encourage them to look for the most inefficient pockets in the world. I also think it's important that they get mentored, that most people aren't ready to just jump right into this business right out of school. So I do think there are opportunities, but people should ask themselves, what are my interests? What kind of edge might I have? If you're from a different country, maybe you have great contacts in that country. Maybe you know a lot about the business culture in that country. And so my advice would be to go where you're naturally inclined and go where you think there may be interesting opportunities. Obviously, a market that's setting all-time highs may not be the best place to focus a career.
This may not be about edge, but Warren Buffett's often talked about index funds. Becky was mentioning index funds to you before, which have changed the business. I think that's actually what's made them so much more efficient to a large degree. But do you also subscribe to the philosophy that if you can invest with Seth Klarman, that you should actually be investing in index funds, and that's the safer and best path?
You know, the argument for index funds is that you're going to have low transaction costs near zero, and you're going to have exposure to the market. You're not going to underperform the market, but neither will you outperform the market. I think for the average person out there who isn't terribly sophisticated and is able to take a long-term view, I don't see anything wrong with index funds. But I think one of the critical things about the long-term return from investing is that it depends on the entry price. So if you enter when the market's very expensive at a high valuation, you may be disappointed because you might match the index, but the index may not do very well from there. So the other thing is you don't want to go into index funds, experience a bad market, and then bail out. That's what investors tend to do. Right. They get in at the wrong time and they get out at the wrong time. And so investors who go into index funds should go in with the idea that they're going to stay through thick and thin.
And you were talking also with Becky about technology. I wanted to understand how you think about the inflection point with a technology company. There, of course, was a point where Amazon might have seemed like a speculation. Today, in retrospect, you wouldn't think that. You might even look at Tesla that way. There are some people in the public market, in the public right now, who think that Bitcoin and various cryptocurrencies are complete and utter speculation. There are others who say 10 years from now, we're going to look back and say that wasn't one. How do you think about that distinction?
You know, Andrew, one of the things that's really important, there's an enormous amount of fire hose of information coming at all of us all the time. And as an investor, I've learned to try to be focused on things that actually are going to move the needle for me and my portfolio. So I try to focus on bottom-up individual situations, stocks, bonds, real estate transactions, and I don't spend a lot of time thinking about things where I think the answer is pretty imponderable. So I do spend time thinking about technology, and part of that, at least, is to avoid being on the wrong side, to avoid being in a company that gets disrupted. I think something like crypto, which I've tried hard to understand the arguments and figure out why people are so excited about it, and I can't find value there. So I'm not making a judgment that it might not go up. I have no idea. but we focus our time where we think we might spend it productively. A lot of money has flowed into virtually everything. Historically low interest rates, even zero rates, have precipitated that bubble. You've also had a lot of changes in the business world. Technology has accelerated, if anything, and you've seen disruption of all kinds of businesses, which creates challenges and opportunities for investors. So that's another thing. Some asset classes have become increasingly popular. Private credit has had a day in the sun. You've had speculation during that bubble in all kinds of things, from crypto to meme stocks to SPACs, in a way that I think, and the book has some important reminders for people about the dangers of speculation and the importance of remembering what kind of environment you're in.
When Graham and Dodd first wrote this book, you were talking about a nation where the economy was really dominated by factories and railroads. You talk about things like SPACs, like cryptocurrency. It seems like a pretty different world. What is the common thread that kind of ties all of this together and how you look at the markets?
One of the things I really admire about Graham and Dodd writing almost 90 years ago is they knew they were in an unusual environment, being enmeshed in the Great Depression, and yet they tried to write something for the ages. They said, we know this won't be the permanent condition, but we don't know what conditions we will experience. So I think every investor has that challenge, that you have to look at the moment you're in and say, which part of this is real, which part of this may be enduring, and which part of this may look completely different as soon as tomorrow, and how do I position myself, maintaining somewhat of a longer-term perspective, because I think trying to trade day to day is not a game anybody really is well equipped to win.
You're a value investor. What does that mean, and what did you learn from Graham and Dodd?
The academic definition of value is buy the stock that's cheapest by the numbers. But I don't think that's what Graham and Dodd wanted. In fact, it's clear that they were talking about earnings power and the growth possibilities in a business, even if they're hard to determine. And so I think value has to be determined for every company. The way I think about the market is not that there are growth stocks and value stocks, but rather that all stocks may hold value, but that all stocks also could potentially be overvalued. So you have to have a mechanism, a rubric for figuring out the value of different kinds of assets, different kinds of businesses, and then figure out which ones are trading particularly mispriced.
I always thought of, or I used to think of value investors as being people who would steer away from growth stocks, that was a dangerous spot that would be hard to kind of figure out. That was pretty interesting that one of your big positions you've taken is in Coinbase. How'd you figure out what the forward earnings are for that? How do you, especially when you start thinking about things that are hard to value, how do you get into that? How do you look at that and say, okay, this is a place that I definitely see value?
Yeah, so I think in a world that's changing as fast as this one, it's really important to think about not just what are the earnings today. The earnings today may not be here tomorrow. They may be disrupted, the business may be gone, or they may be 50 or 100% more. So I think investors need to take into account what are the longer term prospects for a business. I think investors have become vastly more sophisticated these days than in Graham and Dodd's era in terms of thinking about what causes a business to be resilient to competitive threats. Also, Warren Buffett has showed all of us the value of growth, that he thinks hard about some of the highest quality businesses in the world, but only buys them when they're at attractive prices. So I think that's an important element of it as well.
What's gotten more complicated with the markets in the 40 plus years that you've been doing this? And by the way, I should say, when I asked Warren Buffett at one point, like people who could beat the market, because he's long talked about indexing, has always thought that indexing is the way to go. There's probably about 5 people who could actually beat the markets over time, and you're one of the names that he listed on that, which is huge praise from one of the best investors ever. But what's changed for you over time as the markets have gotten more complicated, as there's been more competition? How has your style evolved?
I think you have to almost run harder to stay in place, that you have more competitors, smarter competitors, more information is available at everybody's fingertips. Investors need edge to be successful. They need to think about what is it they know, or how are they structured that will allow them to outperform, to create alpha for their clients in a way that buying the average stock won't do. And so we've become a little bit more focused on private investments. We think there's more inefficiencies in some private markets than public markets. We've become more global over time. When we started, we were a couple of people and $27 million. I think that you can continue to find edge, though, in how you structure yourself, how you incentivize your team, how you lead your team. You can find opportunities around the edges of what other people are doing, finding situations that other people are throwing out, like the baby with the bathwater, and they exist. You have to be patient. They're not always there, but when they're there, they can be particularly attractive because the markets can become quite frenetic these days.